Hey everyone, Mortgage Nerd here. Let's talk about inflation dropping and mortgage rates dropping. We're talking about this all year. When inflation starts coming down, mortgage rates are going to drop as well. Started last month, continuing this month. Let's see what happens today with the CPI. That's the Consumer Price Index. That's how they measure inflation. All right, so what you can see now is the CPI for November. The December readings are for November, just like the November reading was for October. You can see headline CPI went up just 0.1%. Core CPI went up 0.2%. Now, if you average these, if you say 1 month is 0.1, next month is 0.2, for the next 12 months, we're going to have the Fed's target inflation of about 2% by the end of next year. That would be phenomenal, as long as this continues. What's crazy is, part of that core CPI, what's keeping it higher is below. Look below, you see shelter is up at 0.7, rent at 0.8. These are kind of lagging behind. What do I mean by that? Let's illustrate it for you. But think of, this was great by MBS Highway, Barry Habib. I follow them often. You should too if you're interested in mortgage rates. You can see in the front, that's where we have the real shelter cost. What people are actually paying, it's coming down. Then in January, we're going to see kind of peak, because right now we're lagging. The CPI is showing us the shelter still going up, but by January that should peak. February, March, everything start coming down, along with all the other components of CPI that are already low. So that means very good news for Q1, Q2 for inflation, as well as for mortgage rates. Now here you can see, as always, mortgage bonds going up means rates are coming down. 10-year treasury going down means rates are coming down. So here's the mortgage bonds. Early last week, they hit the top. That was the lowest point in our rates in the last few months. And we see today went all the way up, stopped at that same resistance level and came down. It's not great. I was hoping for more. What I think is going to happen is that tomorrow, when the Fed comes out and has their Fed meeting, that's where the markets are really going to move. 10-year treasury came down nicely as well. But again, last week it had a lower point of 3.4. We're at the 3.46. Came down, bounced up a little bit, hitting that level of resistance there, which is the moving day average versus that Fibonacci level. What that all means is rates started moving down strongly today, but they hit the same levels they did recently. So it's not like, here, let's look back here. This is where the October CPI reading came out in November and rates really started to drop. It broke this upward trend that we had going on here. Same thing for mortgage bonds right here. Was a huge upward candle, largest in many years that we had going on. And it broke through all these levels and kept us up here. So that was all very good. But that was because it was the first one going down. Now we had this one kind of soft, but again, I think the Fed meeting today and tomorrow, Jay Powell is going to come out and he's going to talk about what they think. The words he uses, the way he says things, if they're talking about they feel that inflation has peaked, they feel it's coming down, they're going to raise 50 basis points on the short-term interest rates. It's not mortgage rates, short-term interest rates. They're going to raise 50 basis points on those credit cards, car payments, commercial loans, all of that. So maybe next year they'll just sit back and wait to see. He says those types of things. That's going to help the bond market. They're going to feel good. The stock market's going to feel good also. And we'll see hopefully breaking through these levels so we can have lower rates in December than we've had previously in December, because rates are still strongly in the 6s. We want to see them get to the 5s. I predicted this. I said by January we'll be in the 5s. Maybe it'll take the January CPI reading to get us into the 5s for interest rates on mortgages. And then maybe in the 4s by quarter 2 or the end of quarter 1. We shall see. Either way, 2023 is going to be a much better year for inflation, as well as for mortgage rates. So if you're looking to buy a property, don't wait until the rates are lower. If you could afford one now, that is. Because if you wait until the rates are lower, what's going to happen is everybody that's been waiting is going to jump in with you. There's still not much inventory. Everybody's going to buy up those properties or start making offers just like you. You're going to be in the same boat as you were last year and say, well, now I'm going to keep waiting because there's too many people. No, get in with the higher rate, refinance later when the rates are lower. That's the way to take advantage of this market if you can. If you can't afford it, then you're going to have to wait until those rates are lower and you're going to be competing. It just is what it is. Mortgage Nerd out.